Welcome everyone. Kevin and I are back with another video, another Financial 15. A reminder, that's the show, Financial 15. We try to provide some knowledge, something you can use in your financial life to improve the situation. We do all that in 15 minutes or less. And today we're talking about debt, specifically trying to answer the question, do I need to be debt-free to retire? We're going to get into that. You want to stick around.
Yeah, next to reducing taxes, we get a ton of questions that go on about debt. Should I be debt-free in retirement? Can I carry some? What are the advantages, disadvantages, all those sort of scenarios. So again, if you want to find out more information about this, please visit our website at beckerorr.com. Like us on Facebook, or as usual, we've got a variety of different videos that may be able to help you. So please check out the YouTube channel that we have. Subscribe, become a member. We'd love to have you in there. So Clint, we are going to start with this now. Do I need to be debt-free to retire, or can I carry some of this going forward? What do you think?
Yeah, well, it's a little more detailed to get a answer to the question, a little more nuanced, but we're absolutely going to get into that. We'll start with kind of the overview, some stats. What is the current situation for Canadian retirees? And that'll allow us to kind of gauge where everyone will line up. But you can see here, this is from Sun Life. They had a financial barometer survey. They did this in 2018. And based on that survey, 1 in 4 Canadians do have debt in retirement. So you can see the majority are retiring debt-free, but you still have 25% that have debt there, Kevin. And then you can see the breakdown of those with debt. So of that 25% with debt, what kind of debt do they hold? The majority is credit card. You got 2/3 there with unpaid credit card bills. It doesn't add up to 100 because you can be in more than one category. You could have a mortgage and a credit card bill. You could have a car payment and credit card bills. So some folks might be counted twice there in that particular survey. But to give you an idea, retired Canadians on average, you take the mortgage aside, put that aside, there's about $11,204 of non-mortgage debt. That's according to the 2018 survey. What's your first take here of the data here, Kevin?
Yeah, I mean, this seems to be right in line with what Canadians usually do. I mean, as we take a look, if we compare ourselves to our U.S. sisters or brothers, depending on how you want to look at it, significantly, they seem to have more in that debt that's not paid off as fast. Canadians, typically when you get that mortgage, because of everything that goes on, you pay it off as fast as you can. And that way you become a little less mortgage, or you become less debt-free. Now, the unpaid credit cards, I think the fact that we can access them a lot more, that does make perfect sense as to why I would be carrying some things going forward. But yeah, I think 3 out of 4 Canadians being debt-free in retirement is exactly where we should be. I don't see this as being a big nuance to anybody else, but I do think that a lot of people don't realize that 1 in 4 do still have debt. So that's something that we should at least concern ourselves with going forward.
Yeah, and it could be a bigger issue for future generations, right? Home values have gone up. Mortgages have gotten bigger. People might take a little longer to pay them off. So it could be a greater concern for future generations. But I think an additional takeaway there is, in general, if you want a tip, in retirement, income for some folks can be lower. Income can also be more fixed. We're not working anymore, so it's harder to boost our income. And this is generally why we worry about debt. Because if interest rates go up and suddenly those debt payments increase and we have a fixed income, that could be an issue. So generally, this is why we're concerned about debt. I'd argue that's probably why 3 out of 4 Canadians are debt-free in retirement, is it gives you that flexibility and it makes it a little easier to manage on a lower or on a fixed income. So let's go through a little more nuance here, Kevin. Those are the overall stats, the overall idea of why it's a concern in retirement. But walk us through here. What is the good debt, the bad debt? What are the different types?
Yeah, exactly. I mean, if you do have to classify debt as being good or bad, there are definitely advantages on one side that there aren't on the other. So if you have an appreciating asset, and theoretically that would be your home, if we want to look at the mortgage sort of side of things, an appreciating asset type of debt is not bad debt to hold. And the rationale is because you're still paying it off, but that asset continues to grow and grow. So it becomes an asset for you down the road that if it gets sold, you're going to get something out of it. A depreciating asset, though, that's the consumer good. On the previous screen, what we're looking at, that would be your credit card debt. That would be your car loan debt. These are assets that do not get any more appreciation. If anything, they start losing value the further down the line you go. So if you want to hold debt, you're probably better off holding appreciative debt than you are depreciative debt. And that, again, also leads to sort of the secure and unsecured. 9 times out of 10, you're going to find that credit card debt is usually an unsecured debt. It's not like you're sitting there holding the purchases and, okay, well, they can claim those if they want to come after it. That's depreciating there. The car, we know, still has some value to it. But again, secured debt is more or less something that secures the asset you're holding. So as we say on the bottom here, more unsecured debt and debt for depreciating assets, that's what you want to pay off faster going forward. And then usually what you find out is that your unsecured debt or your depreciating debt usually has a higher interest rate than your secured debt. So that's another rational reason for let's get rid of all of that stuff that's unsecured. Let's get rid of the depreciating asset debt first. That would be sort of the general type of good versus bad.
Yeah, absolutely. Absolutely. And I know this makes intuitive sense. Folks think, well, okay, I shouldn't have a high credit card debt. And since there's high interest rates there, I should pay it off first. And that is a good tip. It does make sense. But I think the big question most people will have here is, what about carrying a mortgage in retirement? Often for most folks, that's the biggest debt they have, right? The houses aren't cheap. So you normally have a big mortgage to afford a house. And more likely, in my mind, that would be the debt people might be carrying forward into retirement. So let's tackle that question specifically. What about carrying a mortgage in retirement? I think there's a few factors to look at, Kevin. The first one here, and I'll throw this to you, it's the interest rate. Like how expensive is it to carry that mortgage? That's a key factor.
Well, exactly. That's huge going forward. I mean, back in the 80s when you had, 15, 20% mortgages, it's a huge interest rate to carry. And you don't want to have that in retirement because that's a large piece of what you're going to be paying on a monthly basis. Now, interest rates where they are right now, it's not as bad. I mean, you're at a really low, historically low interest rate. So carrying that forward, you're not paying as much in interest. The majority of what you're paying on that mortgage is going to principal. And that's where it's going to be a big advantage going forward. And especially if you have some savings, if your savings typically on that rule is if you have a higher interest rate that you're earning off your investments than you're paying in your debt, you're probably better off to keep that going forward for a little bit. But that's definitely one that we should look at in figuring out whether or not you want to carry a mortgage. But there's more than that, isn't there?
There's going to be a couple of factors here. In general, the lower the interest rate, the easier it is to carry that mortgage. So it's less for her to pay it off. And we are in a historically low rate time. Doesn't mean it'll stay that way forever, but that's where we currently are. A little more nuanced discussion, though, if you have the extra cash, should you invest that extra cash or should you use it to pay off that mortgage? We do have a whole video on that, so we won't get into it now. We'll link to that video so you can dive into those details. But looking specifically at that mortgage as it relates to retirement, lower interest rate says probably easier to carry it into retirement. But a key item here is simply someone's comfort level, right? Everyone has different comfort levels when it comes to debt. Some folks are okay having a larger debt, doesn't bother them. They don't lose any sleep over it. Others would simply feel better having that debt paid off. Similar idea here to investments and risk levels. Some people, they don't mind gambling a little bit. They don't mind seeing the red on the screen if the trade doesn't go their way. Others want some more security, more consistency. Same concept here when it comes to debt. Everyone's going to have a different comfort level when it comes to debt. So this is less quantitative. The interest rate's far more quantitative. You can put a number on it, say, all right, it's 2%, it's cheap, I can afford it. This is more qualitative, and it's going to vary for every individual, but important to keep in mind. If you have a little less comfort zone, if you're a little lower risk and prefer not to have the debt, well, then you're going to have to focus on getting rid of it prior to retirement because you don't want to be adding stress in retirement unnecessarily, right? Retirement's supposed to be relaxing a little bit, supposed to be stress-free. So you have to make sure that comfort level is key. And the last one here, Kevin, and this is a big one. I think part of the comfort level is going to relate to whether or not you have a plan and whether or not that mortgage is part of your plan. Would you agree?
Yeah, I mean, that's a big factor. And as you mentioned in the previous one, which we wanted to talk about, is the fact that it does relate to risk factors. I mean, there are GIC people out there only, no matter how much you tell them that the market's a good place to be in, that comfort level is there, and that's why they want to do it. But again, that comfort level leads into the plan going forward. It's a reason why you want to have a financial plan with yourself for what your retirement's going to look like. And the reason is you may have planned this already, that, you know what, I'm going to retire a little early. I do still have a mortgage, but you know what, where rates are and where rates may be going, if I plan that already, I can now feel comfortable going into retirement, knowing that this is part of what I forecast for what I'm going to do with my money when I hit retirement. Not having that plan, hitting it and all of a sudden realizing, hey, I've got 5 years left on my mortgage. I'm retiring now. Can I afford to do this? That's going to give you that sort of fear factor. That's going to increase your risk level and definitely make you feel a lot more anxious about carrying that debt going forward, regardless of what the interest rates are. Because yeah, as we've said before, some people can handle debt, some people can't handle debt. And having that plan for it is really essential to being able to say, yeah, okay, I can carry the mortgage forward, or B, no, I can't. I have to get rid of this beforehand. So what are the options I can do? I think that's an important factor to plan and look at how you want to deal with your retirement.
Yeah, and part of planning is also scenario planning. So you can do a forecast and say, all right, what if interest rates do rise in 5 years? Now you're making some assumptions. Doesn't mean your assumptions will be accurate, but it allows you to get a bit of a feel for how affordable that debt is. If payments do have to increase down the road, if rates have to increase down the road, you can do a bit of a scenario testing. Without getting into the nitty gritty of how financial planning works and some of the fancy software that's now at our disposal, but certainly the key level there is if it's part of your plan, you're going to feel more comfortable with it. Or maybe it's part of your plan not to have it. Either case, that's up to you. But the idea being you need to have that plan, and that will certainly be key as it relates to the debt. So we covered a bit of ground there, looking at, do I need to be debt-free in retirement? The stats show us 3 out of 4 Canadians are debt-free in retirement, but not a necessity, right? There are other options out there. And if you're comfortable with it and you have a plan for it, certainly is possible to retire with still a little bit of debt on the books. But if you have more questions, maybe it's about debt, maybe it's about another topic, whatever it happens to be, get a hold of us. We're happy to help out. You can always go to the website, chatwithclintonkevin.com. You can see it on the bottom of the screen there, chatwithclintonkevin.com. Anything else you want to add, Kevin?
Yeah, I mean, we've covered a sample size of what this is right now. It's not the entire package of what debt is and what debt isn't. But again, each person's an individual. That's one thing we have to remember. So no two people are alike into how they want to carry debt into retirement or if they want to carry debt into retirement. So that's why I say, Clint mentioned before, we're here to help. As an individual, we will be able to look at your situation in specific. We don't want to just give you generalizations. We're more than happy to see whether or not this is a possibility. But you now know the basic points. I think we've covered everything we need to for today.
That sounds good. We'll be back again soon with another video. Take care.